FHA guideline changes. There were some recent changes to FHA guidelines. I've been seeing some people that have been burned at other lenders that hadn't taken into account these changes. They went into effect September 4th. The biggest one is going to be how deferred student loans are treated. So the previous guideline under FHA, Federal Housing Administration, was that if your student loans were deferred for a period of 12 months or greater, you didn't have to count that debt or liability against the borrower in their debt ratio calculation. The new guidelines have reversed that, and now whether the loans are deferred or not, we have to count a payment against those deferred student loans. So if there's a payment listed on the credit report, we'll use that payment as a debt payment in the ratios, or if there's not, they're going to take 2% of the loan balance and use that payment. So this is really hurting a lot of people that have deferred student loans. In a nutshell, people with student loans, deferred student loans, are going to qualify for less of a mortgage. So it's really important to watch out for that. A lot of the guys at some of the other mortgage companies aren't aware of this change, and they're pre-qualifying people and not considering the new guideline change, and then we're having getting calls on some catastrophes that are happening at other offices. Another one of the changes have to do with grossing up non-taxable income. Used to be the maximum would be we could gross up non-taxable incomes to be like Social Security or disability by 25%. They've reduced that now to 15%, or we always use what the actual effective tax rate for the borrower is if they have a filed tax return. One of the other things that is probably going to aggravate a lot of people, it has to do with gifts and how we document the gift. So the donor would be, say, a family member. They're giving, with FHA, the borrower can use a 100% gift from a family member for down payment. We used to just document that with, we have to show it coming from the donor. That would be, say, the parent to the child. We would use a canceled check, just a one piece of paper, or canceled or cleared check to document that transfer. Well, now we actually have to get a full bank statement from the donor. So just a little bit of extra paperwork there. One of the good things that's happened under the FHA guideline changes that happened September 4th has to do with projected income. So say someone that is leaving an area, going to another area, they have an ironclad offer contract for a new job, but the job, say, won't start for 30 days. We can actually use that income for the new job as long as they have a contract that we can document to qualify them for a mortgage. So they could actually move here or be in between the past job and the new job and not have even started working on the job and received the pay stub yet, and then we can use that. It's called projected income, and we can go out as far as 60 days with that. So we could close on the loan as long as the new income is going to start within 60 days. So those are just some of the highlights of the recent FHA guideline changes.